Now, in the west of the continent, inflation has also cooled in Ghana and Nigeria. Ghana's CPI fell for a fifth consecutive month, dipping to 20.4% in August from 20.9% previously. Nigeria's inflation, in the meantime, eased to a six-month low of 32.15% during the period from 33.4% in July. Lourens Harmse, head of Africa trading at RMB, joins us with his analysis on the inflation trajectories of these two nations and what it may mean for interest rates moving forward. Thank you so much for your time, Lourens. Now, 3 consecutive months of decline in inflation, and that at a six-month low in Nigeria. What story is this telling us?
So it's interesting. There's a lot of news flow around Nigeria at the moment, and as you rightly say, I think even globally the inflation story is quite topical, and the rate cycle seems to be turning. And I think in Nigeria, in a lot of African nations, we've seen quite a bit of inflationary pressure come through over the last few months. Excuse me. And in Nigeria specifically, we've seen recently the naira devalue quite significantly over the last few months since the new central bank has come in, and we've seen fuel prices go up as well. So the inflation there has been under quite a bit of pressure, and it seems like, just given where we are now in the cycle and kind of the base effects coming through, inflation's starting to cool, which is a good sign for Nigeria in general, because I think that the domestic economy has been under quite a bit of pressure. The consumers are struggling, and the rates environment as well is quite punitive, making it very difficult to stimulate growth. So we look at inflation cooling, probably starting to cool to a point where we'd start to see rate cuts in Nigeria, but probably only towards the first quarter of 2025. But it's really positive for us that we expect them to pause at next week's MPC, just given this trajectory.
Would you say that the biggest component of still the pressure that we are seeing there, of course it is cooling down, but still the pressure that we are seeing, would you say that fuel is, the biggest component there? And just talk to us about what that fuel picture looks like.
So the fuel picture in Nigeria is quite interesting at the moment. There's a lot of shortages across the country. Supply is not able to meet demand at the moment. And what we've seen is the National Petroleum Company has actually allowed fuel prices to adjust to market levels, which has been a big shock. These are the fuel subsidies, quote unquote, that has been in the market for quite some time. And as a result, fuel prices at the pumps shot up by, I think to date, or in the last 2-3 weeks, by about 67%. And I don't think the whole effect of that has fed through, or it wouldn't have fed through into the latest inflation print we've seen. On the other side of the spectrum, the other big component of inflation is food, and that's due to an increased crop and better production, and also the 100-day subsidy-free window that the government brought in for food imports. So that should offset the fuel to a large extent. So, but again, the fuel story is extremely interesting in Nigeria at the moment. There's a lot of moving parts.
Also, one of those parts is obviously the currency risk. How much of an impact is the currency risk, particularly on the interest rate decisions that are being made? Earlier on, you mentioned that the rate environment has been quite punitive.
So the currency has multiple downstream impacts in the economy. I think obviously Nigeria has a big current account deficit. They're a net importer of food and to date fuel. And this currency effect now with the removal of the subsidies by the NMPC will be seen to feed straight through into the consumer. So if you look at the pricing now, it's broken down into the components, and FX is a direct input. So with FX at these levels, we're going to continue to see this pressure build. So given the structural imbalance we see in FX still, with limited flows, and there's various factors that contribute to this, but largely we've seen a lack of the levels of foreign investment we've seen in the past, although everything is at really attractive levels. So you've got a very high rates environment, you've got a relatively good entry point in FX, but yet we're not seeing any of these offshore flows that we used to in the past. I think that's largely driven by, two factors. there's been a rotation into other markets that are starting to also turn, with the likes of Egypt and Ghana looking quite attractive. And the concern that offshore investors are having at the moment is there seems to be a little bit of policy uncertainty or lack of communication by the authorities on where to next. The positive that came out yesterday to address part of this communication issue was the 2024-2025 sort of fiscal and monetary policy document by the central bank, which details everything around macroeconomics, foreign exchange policy, certain rules and regs around foreign exchange, etc. But it's just not enough yet for us for us as an offshore community to say, well, okay, now we see the path here.
Yeah.
And I think that's why rates probably will stay on pause.
Okay.
Until such time that we get that clarity and just open comms.
Yeah. All right. Well, let's cross on over to Ghana because that's also really moving on inflation reduction. What's providing relief there?
The Ghana also base effect, and FX has been relatively stable. We've seen it under pressure now, but Ghana's quite interesting because we've seen Ghana go through a lot of painful decisions in the last 2 years. They've gone through a local currency bond restructuring, which is something we haven't seen in an African government, well, in the recent past, which was painful, but it was a hit they took up front. And the structure of those bonds was also quite strange. It was a reduction in bonds, and it wasn't really easy for the market to get involved in those bonds. Also took out a component of what they usually use to fund their current account, foreign portfolio investment. But given the inflation story and the pain they've already taken, and we're seeing that these conditionality of these bonds roll off, it's actually starting to really show up on investors' maps again. So we're seeing a lot of interest for Ghana longer dated bonds, something that hasn't really been trading in the last few years.
Okay.
So it's an exciting story. I mean, Ghana, if you look back 10 years, was always the darling of the investment world. And I think they're starting to come out of that now. And in addition to that, we've had the hard currency sort of restructuring also a lot better handled by the government of Ghana in terms of quick response times and getting to agreements. If you compare that to the Zambia restructuring, that's taken almost 4 years.
All right. Well, thank you so much for your time and giving us insights on the inflation picture there in Ghana and Nigeria. Lourens, much appreciated. That was Lourens Harmse, Head of Africa Trading at RMB.